Is Sony too broke to buy Kadokawa? What would Sony really gain by acquiring Kadokawa? Is it all about From Software? Or is this a bigger play for control over anime and media as a whole? Is Tencent the bigger threat here? With their existing stake in Kadokawa and aggressive buying history, could they outmaneuver Sony? Why isn't Microsoft seen as a major risk in this fight? Does their lack of presence in Japanese markets make them a non-factor? Or could they still surprise us? What's stopping Kadokawa from staying independent? Are we underestimating their willingness to keep their company intact and avoid a buyout altogether? If Sony pulls this off, how would it reshape gaming, anime, and entertainment as we know it? Could this be the move that secures Sony's dominance or backfires completely? Relax, grab your favorite beverage, and let's explore this rabbit hole together. In this video, we're going to break down what's really at stake, who's playing the long game, and how all of this could impact the industry for years to come. Let's get into it. So this article from Gameranx says that, and I quote, Sony may have hit a speed bump in its supposed plans to acquire From Software parent company Kadokawa, and it has to do with how expensive this purchase would be. Earlier this month, rumors started to spread of Sony looking to buy Kadokawa. More recent reports have indicated that Kadokawa would only be interested in a deal with Sony if it is a complete buyout, all anime and gaming assets included. This might prove to be a complication for Sony, at least according to Japanese finance outlet Toyo Keizai via Automaton. The cost of purchasing all of Kadokawa's assets would be upwards of 640 billion yen, approximately $4.3 billion, which might be too steep a price for Sony in the wake of its other recent investments, like its 2022 buyout of Bungie. There is also the possibility that Sony's hypothetical attempt to buy Kadokawa could trigger a bidding war, which could drive up the price even further. Earlier this year, Sony Group stated that it was planning to allocate roughly $12 trillion for investments and share repurchases, but this could already be stretched thin due to other purchases, like music rights. For example, Sony Music spent around $1.27 billion to acquire Queen's song library back in June. If Sony really does want to acquire Kadokawa's subsidiaries, like From Software, it might attempt to do so by buying 15% of the company's shares to turn it into an equity method affiliate, or 50% to make it into a subsidiary that it doesn't fully own. Only time will tell how this all plays out, even as industry insiders and outside observers alike speculate on the long-term impact that Sony purchasing Kadokawa would leave on gaming, anime, and television. Alright, let's break this all down, because there's a lot to unpack here. A lot of people are comparing this situation to Sony's $3.6 billion acquisition of Bungie, but the context is pretty different. When Sony bought Bungie, it was mainly for their expertise in live service games, something PlayStation has been trying to break into. But let's be real, the Bungie deal hasn't exactly been smooth sailing. Destiny 2 hit some rough patches with its Lightfall expansion, and Bungie's high burn rate led to massive layoffs in 2023 and 2024. Things got so bad that Sony leadership had to step in and take control, shifting Bungie's focus to running Destiny 2 like a business. It's clear that Sony learned a hard lesson with Bungie. They wanted the studio's live service expertise, but managing a company with strong independent vibes and big egos wasn't easy. Bungie's struggles show how tricky it can be to fully integrate a company into Sony's ecosystem, especially when there's resistance to change. Now, compare that to Kadokawa. If Sony were to buy the entire company, it wouldn't just be managing one studio, it'd be taking over a massive media conglomerate. And this is where things get messy. Sony's already stretched thin after recent acquisitions, like the Bungie deal, and even spending over $1 billion to buy Queen's music catalog earlier this year. Dropping another $4.3 billion might be a hard sell internally, especially if it risks sparking a bidding war with companies like Microsoft or Tencent, who could also make a play for Kadokawa. One alternative being floated is that Sony could avoid a full buyout and instead buy a controlling stake, like 15% or even 50%, to turn Kadokawa into an affiliate or subsidiary without taking on the entire company. This would give Sony access to From Software and other assets without biting off more than they can chew. But even that comes with risks. Would Kadokawa agree to a partial deal when they've reportedly pushed for an all-or-nothing sale? So, we spoke on this topic before, I believe twice, and I got some comments saying that it's impossible for a foreign company like Microsoft to buy a Japanese company. So I did neither confirmed or denied these claims, although I did have some memories about something similar to this, though pretty vague. Anyways, I decided to do some digging on this matter, and it's actually a bit more complicated than it might seem, so check this out. First for Microsoft it would be a bit harder, but for Tencent, a Chinese company, a lot easier than you might think. So in 2021, Tencent, through its subsidiary Sixjoy Hong Kong, acquired approximately 6.86% of Kadokawa Corporation by purchasing 4.86 million shares shares for about $264 million. This investment made Tencent Kadokawa's third-largest shareholder. As of now, there is no public information indicating that Microsoft holds any shares in Kadokawa Corporation. Now, let's look at what the Japanese law says about buying out companies. Japan does not have explicit laws prohibiting foreign companies from acquiring Japanese firms. However, certain regulations and cultural factors can make such acquisitions complex. The Foreign Exchange and Foreign Trade Act, FEFTA, requires foreign investors to notify and, in some cases, seek prior approval from Japanese authorities when acquiring significant shares in companies involved in sensitive sectors like national security, weapons, nuclear power, and aerospace. For instance, under FEFTA, if a foreign investor intends to acquire 1% or more of a listed company operating in a designated sensitive business sector, prior notification to the Minister of Finance and the relevant ministry is mandatory. This threshold is lower than the previous 10%, indicating Japan's increased scrutiny over foreign investments in critical areas. Beyond legal requirements, Japan's corporate culture and business practices can pose challenges to foreign acquisitions. Historically, Japanese companies have been resistant to hostile takeovers, and there's a preference for maintaining domestic control, especially in industries deemed vital to national interests. In summary, while foreign entities, including companies from the US or China, can acquire Japanese companies, they must navigate regulatory approvals and cultural considerations. Each potential acquisition is evaluated individually, with particular attention to the industry's sensitivity and the potential impact on Japan's national security and economic stability. There is also this sentiment online that Sony is broke, or Sony is desperate, or Sony falling apart after Concord, and PS5 Pro costs $700 because of that. Let me tell you something, Sony is doing just fine. They have so much money that they can afford one Concord flop every 2 years. While I hate that Sony tried to go full live service route, and that budget could have been used for another Spider-Man or God of War game or remastering Bloodborne or make Days Gone sequel, the reality is they can afford to experiment, and they can afford experimenting. And Concord is one of the biggest flops in gaming history. And despite that stellar Blade winning dozens of Game of the Year awards in Korea, Helldivers 2 snagging awards left and right, and all categories in Game of the Year are dominated by PlayStation-owned IP. But besides that, let's look at how much cash Sony really had. As of December 1st, 2024, Sony's net worth, or market capitalization, is $121.26 billion. Market capitalization is the most common way to measure the size of a publicly traded company. It's calculated by multiplying the current stock price by the number of outstanding shares. Sony's subsidiaries include Sony Interactive Entertainment, Sony Music Japan, Sony Pictures Japan, and more. In the second quarter of 2024, Sony reported a profit that was higher than expected, with a 73% increase in operating income year over year. This was due to the strength of its game and network services division, which includes the PlayStation brand. Conclusion: they can afford Kadokawa, but business is always 10 times more complicated than that. In a bidding war, Tencent poses a much greater risk to Sony than Microsoft. Tencent's aggressive investment style, existing stake in Kadokawa, and global ambitions in gaming and media make them the more likely competitor. Microsoft is already deeply invested in its recent acquisitions, like Activision Blizzard, which has taken significant resources to finalize. And right now, they are being investigated for antitrust laws regarding this acquisition. The real question is, if it came down to Tencent and Sony, would Sony be willing to go all in to keep Kadokawa, and more importantly, from software, out of Tencent's hands? That's where things could get really interesting.